You're listening to the Practical Wealth Show with Curtis May, putting you in the driver's seat to control your finances. Let's start the Practical Wealth Talk about alternatives to Wall Street.
All right. Hello, everybody. Welcome to another edition of the Practical Wealth Show. This is your host, Curtis May, and I am very excited to introduce to you Peter Hugg. And so the title of this episode is called "Got Gold," right? And should gold be a part of your investment portfolio? So let me give you a little bit of Peter's background before I introduce him. So Peter Hugg is the director of global trade for Kitco Metals Inc. And he's been involved in the precious metals industry since 1974. And he speaks to thousands of viewers each week on Kitco News, drawing on years of frontline experience to provide a trader's perspective on the market. And Mr. Hugg contributes daily commentary, which is very interesting. I got to pull up that article now that I think about it, so I can ask you about it. I had questions, and commentary and market insight for millions of readers on Kitco each month. And so Peter speaks frequently at Precious Metals Conference and in the financial media. And, he's one of a handful of experts that have succeeded through multiple bull and bear markets using skills honed during the dramatic fluctuations of the 80s. And prior to joining Kitco, Mr. Hugg served as senior vice president at Guardian Trust Company, now a part of, Lintarian Bank, which has become the largest international trading houses for precious metals. And Mr. Hugg developed the first precious metal certificate program and the first margin trading accounts for the metals on the cash market. So I'm excited I'm honored actually to have Peter Hugg on our broadcast today. And so, Peter, say hi to my listeners out there.
Hi, everyone, and it's a pleasure to be here, Curtis.
Thank you. So, Peter, tell us a little bit. I know I read your bio there, but you have this is kind of like your would you say your second career? Not second career, but you started. What did you do before Kitco? Tell us a little bit about Kitco, and then I want to kind of go into some of what you see what's going on out here in the markets.
Well, it's kind of a story that got me into this career by accident. I graduated out of the University of Toronto back in '73, and actually graduated wanting to become a teacher. And at that time in Canada, teaching jobs were slim to none throughout most of the country. And a friend of mine who was working for the largest foreign exchange retail dealer in the world at that time, a company called Deke Pereira, offered me a job in the foreign exchange business, and I turned him down 3 times. I mean, I couldn't understand why that was even a business. And but anyway, I finally I conceded, and I started working on the foreign exchange desk of Deke Pereira in Canada. And within the space of about 6 to 9 months, people left. And other people were relocated, and I ended up being the chief dealer for Deke Pereira for the Canadian operation. So I cut my teeth on the foreign exchange market between 74 and 76. And then a company out of Quebec, Guardian Trust Company, who at that point were worried about the Quebec referendum and the Quebec leaving Canada, thought it might be prudent if they expanded their presence outside of the province, and they opened up an operation in Toronto. They were also a foreign exchange dealer, so my skills brought me to their attention. But at the same time, they were dealing in a retail precious metals operation in Montreal, Quebec. So we brought that metals operation over to Toronto and incorporated that into the Toronto operation. And we're fortunate enough to be in the market in the 79.80 market move, where gold moved up from just under $100 up to $850, and silver ran from about $4 to $50 an ounce. And we then became one of the largest wholesalers of precious metals throughout the 80s in Canada. And in '92, the operation was sold to a French bank called Laurentian Bank. And at that point, I had small children and I didn't want to move to Quebec. So I got out of the business in '92 and then found myself the CEO of a public company that introduced microchip identification for pets in North America. I did that until about '99. Then I moved to the Bahamas, worked there for 3 years. Then I worked in New Zealand as a trader for a metals operation in New Zealand. And then in 2010, I was approached by Kitco, which was a company that was the leading company for online trading in retail precious metals in North America at the time. The owner of the company actually was a client of mine way back in the 80s when I ran Guardian Trust, and asked me to join the company. The company had grown from 7 people in 2001 to almost 240 people by 2010. So he asked me to run the precious metals division for Kitco. So I joined Kitco in 2010, and I'm still in charge of the risk management for the precious metals operation for Kitco. So that's sort of a capsule.
All right, good stuff. So tell why why should people why should gold be part in your opinion, why should gold be part of somebody's portfolio?
Well, I'm not one of these. Again, I've been around since '74, so I'm not one of these guys that's saying the world's coming to an end and gold's going to go to $20,000 an ounce and you should sell everything you own and buy gold because the world and the financial system is going to collapse. I've never sort of been a proponent of that line of thought. There are times when gold makes an excellent investment, and there are times when gold is not as good an investment. And it really, gold isn't the where all be all of an investment from the perspective that you always need to be long gold. There are times when the gold price drops. Perfect example is if you had gotten into gold in 2011 at 1925 and gold today is trading at 1340, it looks like a lousy investment. Had you gotten into gold, in 2008 when gold was trading, south of $600, and you managed to trade that up through 2011 when gold hit 1900, it would have made an excellent investment. So there are times to be positioned in gold on a more aggressive basis, whether it's gold, physical gold bullion, or, whether you are a proponent of the ETFs or gold mining shares or mutual funds. And there are times when you want to be less aggressive in the gold market. So what I did was I looked at, what was similar back in 79, 80 when gold ran the first time to $850 and silver hit 50 for the first time. And then I looked at it again in 2011 through, the last few years. And, really nothing much has changed in the gold market in that span of time. There is only one other investment now that is available that was not available back in 79 to gold investors, and that is the ETF market. Back in 79, you could buy physical gold, you could buy futures contracts, you could buy options, you could buy gold mining shares, you could invest in managed mutual funds that invested in gold. So, really the only new development in the gold market, other than the online presence of gold, which obviously wasn't available in 1980 when nobody even had computers, is the ETF market. And throughout my career, when I go to conferences or when I write comments, the primary question that I get asked from clients is, should I buy gold? And so what I did was I sort of looked at the profile, the psychological profile of the various gold investors that I've run across over the past 40 odd years. And that profile, ironically, has not changed at all since the run in 79 to
Okay.
80. The psychologies remain relatively similar. And I'm sorry, go ahead, Curtis.
No. I'm saying no. I was going to say I was going to ask you that. So walk us through the psychology of the metals buyers. I think that's very interesting.
Yeah, so when I looked at it, I was able to sort of break sort of metal investors into four groups. And, putting labels on these groups is not generally fair, but I'm not sure how else to do it. But so the first group that I sort of identified, and it's a group that tends to be much more prominent in the U.S. than in Canada. Canada has a more of a conservative slant to their investor psychology. Is a group that believes that the financial system is going to collapse, that the government may ban gold ownership like it had once done prior to the Bretton Woods dissolution back in '73, and that they're going to need gold as a barter system when the when the economy explodes. They're going to need gold to be able to barter from a financial perspective. And this group sounds like a fringe group, but it really does take a considerable amount of offtake off the physical precious metals market. And they are not that sensitive to price. They believe somewhere down the road, the gold price is going to be $5,000, $10,000, $20,000 an ounce. They usually buy gold in small increments, in 1 gram wafers or less than 1 ounce size bars, because they believe they're going to need the smaller units to be able to barter effectively when the financial system collapses. They are likely not to liquidate their precious metals into a rising market. They are basically buy and hold type of strategists. And they tend to have a fairly substantial part of their portfolio allocated towards physical gold. Another element of this group is that they don't trust institutions. Therefore, they are very unlikely to hold gold with a dealer, either in allocated form or in trading accounts. They stay away from ETFs. They don't trust the paper market. They certainly don't trade in the COMEX. They are basically almost exclusively physical buyers of gold, usually in small denomination bars. The second group, which is sort of the more mainstream group that gets involved in the precious metals market, again, just for lack of a title, I call them the conservative investors. And they tend to hold a portion of their gold, 5, 10, 15% of their assets in gold. They also engage in the physical market, but they are not as worried as the first group, and also engage in the ETFs and the gold mining shares and mutual funds. They are less worried about holding gold on an allocated basis with dealers. And their percentage of their holdings in gold tends to represent anywhere, again, between 5 and 10%. Now, that group is usually influenced by analysts that say you need to hold 10% of your assets in gold. But what these analysts always fail to do is to mention to this group of investors that you need to calibrate your portfolio. So just to give you just rough mathematical example, had you bought gold in 2008 at $700 an ounce, with the intention that you wanted to hold 10% of your assets in gold, in 2011, when gold hit $1,900, and if you looked at your portfolio, that 10% was probably now going to be 18 or 22% of the value of your portfolio. In that context, you need to sell that surplus of percentage holdings in gold to bring yourself back down to 10%. Vice versa, had you got in at 2011 at $1,900 and gold in 2010 was back down at $1,050, your holdings were probably down at 4 or 5% of your portfolio. At that point, you need to add more gold to your portfolio if your intention is to hold the 10% insurance position against the balance of your portfolio. So you need to calibrate. You can't just buy the gold and just forget about it if you're in that second group of investors. It's basically something you need to manage. The third group, which we call the trader, doesn't care if gold goes up or down. What they're looking for is volatility. A trader's persona is to make capital gains. They're looking for the least expensive way to invest in gold. They're usually looking for leverage. You'll find the trader more engaged on the futures market and the options markets. They can be bullish at 9 o'clock and bearish at 9:01. They're just looking for movement, and they're trying to capitalize by either being long or short the market on a movement for the ultimate aim of capital gains in the trade. And whether they're trading gold or oil or soybeans, these guys are usually leveraged, and they're looking for a quick in and out type of trade to make a capital gain.
Okay.
The fourth group, for lack of a better way to say this, I call them the collector, and these and it sounds like a small group, but it isn't. These are individuals that are enticed by offers from a variety of sovereign mints and some private mints around the world that issue coins that are themed. You could buy a Batman coin or a Darth Vader coin or an airplane coin. They usually come in boxes. They look really cool. People tend to buy them as gifts. They end up in the drawer, and somewhere down the road, they either get melted or just sold for scrap. They're not great investments because you're paying a substantial premium to the inherent metal content of these products, and you're paying for the box and the fluff. So they're nice gifts, but they're not what I would consider viable precious metals investments. But I bring that group up because they do contribute to a sizable offtake of the physical market that is produced by the sovereign mints around the world. So where you fit in that group would determine, should you be buying gold, how much gold, and in what form should you be buying it? Should you be buying it from a leveraged perspective if you're a trader? If you're in the first group, should you be buying small units, taking delivery of those units? Should you be looking not only at diversification in your portfolio with gold as a diversifier, but should you also be considering geographical diversification? If you're worried about your country of residence, you might want to consider holding some of your gold outside of that country, so you have some geographical diversification as well as asset diversification.
If you want to leave the country, your goal. If you want to, I've heard somebody say this. Like, so they talked about the Perth Mint, for example. So if you want to leave the country, your money is already there. Your gold is already out there, outside the country.
I mean, for Americans, Canada is a phenomenal location, and Canada has it's not really talked about a lot, but relatively strong privacy laws. For example, the IRS cannot come into a Canadian dealer and just ask for a random subpoena search for all of the records. That's just not allowed under Canadian law. They have to have a specific case against an individual. Then they have to apply through the Canadian courts, who, if they then concur, would issue a subpoena to a dealer to release a specific record. But there is no general subpoena search law in Canada. And the other advantage of Canada is the proximity. I mean, you can literally just drive across the border and either visit your gold or pick up your gold in Canada. But there are more and more individuals on a global basis that are storing gold in Europe, Singapore, Hong Kong. So there are a variety of storage options, allocated storage options that are available to investors on a global basis, much more so now than there was 10 years ago.
Wow, that's interesting. One of the things that you said there that I think that I always tell people, investing is a plan, and you've got to have a thought process of how you deal with money. So, like, I personally don't really look at uh, gold as an investment. I look at it as insurance. So I'm somewhere between the way you laid it out, between 1 and 2. I'm probably on the low end of 1, where I don't believe the sky is falling. But since my primary business is insurance based, I view it as insurance, a hedge, or as money, So so where dollars and pounds go up and down. Well, no, I try to focus on the dollar. I mean, the gold as the constant, because all the rest of these things are fiat currencies. And so I tend to look at it and having a percentage in uh uh physical gold. I don't really like paper because I don't like counterparty risk, and because if they're selling a paper, it's like the so I guess I'm one of those people. Number one, right? If like if everybody wanted all of their gold and there's not enough gold for the paper they sold on it. I've heard. And so maybe that's a conspiracy theory. So I don't want to put that out there if that's wrong, but I like if I have it or it's stored somewhere, boom, I have no counterparty risk. It's just uh it's there if I need it, and it's been money for 5,000 years. So I like that. So
Yeah,
yeah.
well, yeah, and I don't disagree. I don't disagree with your logic. Um, uh, what I would, if you're going to go that route, though, I would suggest that when you are buying physical gold, that you don't get caught up in the raw hype of your own country. And let me try to explain that without, and I don't mean to be. I don't mean to insult anyone here, but let me just give you an example. If you're an American, uh, you want to buy, or most Americans like the American Gold Eagle. Now, there's nothing wrong with the American Gold Eagle, except that in Canada, you can't really give a Gold Eagle away to a dealer, or there won't be an aggressive bid for a Gold Eagle. And the reason for that is because the Gold Eagle is a 22 karat coin. It's similar to the South African Krugerrand.
Okay.
In Canada, a Gold Eagle is taxable when you buy it. So obviously, if a client is trying to sell Gold Eagles in Canada, they're going to get a less aggressive bid than they would from a U.S. dealer. Also, in Hong Kong, you can't give a Gold Eagle away because the Chinese like 4/9 gold. So if you are going to buy gold and you are looking for some kind of geographical liquidity, consider buying the Gold Buffalo, which is a 4/9 gold coin made by the U.S. Mint, or the Royal Canadian Mint Gold Maple Leaf. So as opposed to just being myopic and saying, well, it's a Gold Eagle, I've got to buy it because it's an American coin. It's good if you're just going to hold it in the U.S. and you want to sell it in the U.S. But if your worries are that the system is going to collapse and you might need to take this gold and move it outside of the country, you should also give some consideration as to what gold products offer the most liquidity on an international market. And the Gold Eagle does not fall into that category.
Wow, that's a good point. So how do you know if you're getting a fair price?
I'll tell you what the cost is to a dealer, and then you guys can figure it out from there. So the U.S. Mint sells their Gold Eagles, and this is delivery local San Francisco. So the dealer, again, depending where the dealer is, also has shipping and logistics costs to move it to their location. Let's assume the guy's sitting up in New York. So he's got to move the gold from San Francisco to New York, but let's assume there's no cost of transportation. The U.S. Mint sells Gold Eagles at a 3% premium. They don't give a break to a dealer that comes in and wants to buy 50,000 Gold Eagles or 1,000 Gold Eagles. It's 3%, doesn't matter what you buy. So if gold is right now trading at $13.40, the acquisition cost of a Gold Eagle by a dealer is approximately $40. Well, if the gold price is at $13.40, the dealer's cost for that coin delivered to San Francisco is $13.80. Now, anywhere over $13.80 is where the dealer adds their spread. So it's really up to the retail public to just price compare dealers. And, there's a number of large dealers that trade in the U.S. and in Canada that also, such as Kitco, that make delivery into the U.S., that post prices on Gold Eagles. So based on the price, you know what the dealer acquisition cost is, and then you'll see what that spread is. Now, where you might get a better deal than that 3% is what is called the secondary market. So you'll have a dealer that has a client that comes in and sells him Gold Eagles, but they're not paying 3% to the retail investor that has sold the Eagles. They may be paying, a $10 premium or a $15 premium to the spot price. So now their acquisition cost isn't $1,380, but $1,355. That dealer, depending on the inventory, might give those eagles at a discounted price to what would be called source eagles, which is eagles that are bought directly from the U.S. Mint at a 3% premium. So it's really a matter of shopping, the same way you would for anything else. Some dealers, depending on their size and their inventory capability, offer considerably better prices than sort of your local dealer sitting in a mall somewhere, John Doe coin dealer, where you walk in. They've got cost of carry for their inventory and all that, and it's likely that their selling price for eagles will be more expensive than a bigger primary dealer that's in the market. So it's really just a matter of comparing price and shipping and insurance and finding out what your delivered price is, and then dealing with the dealer. The other suggestion would be that you would want a dealer that's got some history. I mean, a dealer that just has opened up their operation 6 months ago, not saying that there isn't anything necessarily wrong with that dealer, but I'd be more comfortable dealing with the dealer that's been around for a few years, has been around not only in markets that have gone up, like between 2008 and 2011, there were some 50, 60 new dealers that came on the market about every 3 months. And then when the market started to sell back down, these guys all just basically closed shop. So you want a dealer that's been around, has seen the ups and downs in the markets, has weathered both the good and the bad markets, which will give you some comfort level that when you wire funds to them, that you'll actually get the product on the other end.
See how that will be important, right? That make sure you get the stuff that you pay for. What? Let me ask you another question. What are the best quality products? So I've because just the proof. So what is 9999 versus 999 versus 925, for example? And how can I be sure I don't get fakes if I'm getting direct delivery?
Let me answer your last question first. There are two product lines that most of the bigger dealers offer. One is, and again, they all use their own marketing terms. It could be Mint Direct or I forget what some of the other terms are, but these are products where you come in as a client and the dealer guarantees that the product is delivered from source, which means that it has never been circulated. So this eagle or gold maple leaf has come directly either from the U.S. Mint or from the Royal Canadian Mint. It has never touched somebody else's hands from an investor's perspective. So you are getting metal from source. The second way you can get metal is on the secondary market, where dealers have bought back product from clients and they resell them as secondary product, as I mentioned before, which usually comes at a less expensive premium than sourced product from the mint. There you need to rely on the reputation and the credibility of the dealer that you're engaged with. Most dealers that are worth their salt have extremely sophisticated test protocols on any secondary product that comes in. So it's really you're buying the reputation of the dealer when you're buying secondary product. Now, what is a better coin? The fact that an eagle is a 22 karat coin doesn't mean it's not 1 ounce of gold. It's just it's got components within the coin that make it way more than 1 ounce of gold, but it's still 1 ounce of gold in the eagle, except it's 22 karat. It's not 24 karat, which is a 4/9 gold coin, such as the Buffalo or the gold maple leaf from the Canadian Mint.
Okay. Let me ask you, let's segue into let's talk about silver for a second. And what's the difference between buying gold and buying silver, and should you do both?
I like silver. Let me say this another way. When the markets are going higher, silver tends to outperform gold. And vice versa, silver tends to be more volatile on the way down than gold from a percentage movement perspective. One of the components with silver that makes it somewhat, uh, which sometimes has an effect on the price, is silver is also used as an industrial metal. It's the primary use for silver as an industrial metal. It's not an investment metal. So if there are circumstances on a global economics basis, whether the global recoveries are deflating or there is a lack of genuine uh, manufacturing demand for silver, you may not have silver perform as well as you would gold in a time of turbulent economic periods. If everything is equal, silver tends to outperform gold on the upside when the markets are in a bull run, and also outperforms gold on the downside when markets are in a bear run. Silver is referred to as the poor man's gold. It Over the past 2 years, it's sort of averaged the medium ratio. If you're looking for how many ounces of silver to an ounce of gold, has been trading around 65 ounces of silver to an ounce of gold. Currently, silver is trading at about 80 ounces of silver to an ounce of gold. So if you are bullish the metals complex, silver, in my opinion, at current prices is a much better investment risk than gold.
Interesting. Okay. And so let's say we're buying these we've decided we're going to add every month a little bit of metals to our portfolio. Where should I keep my precious metals?
Again, that's really, it defines what type of risk you're willing to take. Most larger dealers offer what are called allocated storage programs, where the metal is held in your name. It's off balance sheet from the dealer, so there's no credit risk to the dealer, and it costs you a storage fee. Now, the storage fee is relatively incidental. It'll range anywhere from about a quarter to a 0.5% per annum on the value of the metal. What that helps you with, though, is that the metal then is already with the dealer. So if you're looking to liquidate it, you don't need to worry about getting your metals packaged up and sent to the dealer. I mean, you have immediate liquidity or access to the sell side of the market if the dealer is holding your metal. The other option, in most dealers, depending on price point, most dealers will offer free shipping and insurance to your home. So now then you've got a situation where you've got the physical metal sitting in your home, generally not covered by your insurance rider, your general homeowner's insurance rider. You would probably have to get a separate rider on the precious metal, similar to what you would need to do for jewelry. And then you would have it in your home if you felt comfortable with that, or you could just take delivery and walk down to your bank if you have a safety deposit box and stick it in there. But again, now by taking delivery, you have the risk of the insurance and or the risk of theft with the metal being in your location as opposed to being in a dealer's vault somewhere. But again, you need to have the confidence that if you're storing it with the dealer, that the metal is there, and you're comfortable with the dealer's reporting on how that metal is held. Now at Kitco, we have two services, one offered by a COMEX-approved depository in the U.S. and one by the Royal Canadian Mint, where there is a statement at the end of each month that actually delineates the holding of the client account metal in those storage facilities. So you're getting a third-party confirmation of your storage of what you're holding in those locations. So that would give you at least third-party confirmation of your metals holdings. Other dealers will provide an outside audit, either quarterly, semi-annually, or once a year, where they have external auditors coming in, and they actually count all of the allocated metal in the account by client, and then they report directly to the client that based on their review, that the client does have 10 1-ounce gold eagles sitting in his account. So you really have to read through the storage agreements and see how the dealer confirms and how the dealer holds the metal and what type of reporting you get to make yourself comfortable that the metal is
I like that. One of the things I take back, and I want to ask you one other question, and I want to go back. I want you to tell them about Kitco and how you can help people. what I want to make a point is that guys, when we talk about the seven principles of prosperity and where this fits in, the first one is think from a prosperity mindset eliminates poverty, scarcity thinking keeps you stuck. But and I want you, which is going to lead to my next question, which is C, right? You need to think from a big picture perspective. What I try to teach people and my clients is to have a kind of think from a macro perspective so that you can understand what's going on. Yeah, I had a mentor tell me one time, if you know what's going on, you'll know what to do, and don't just make decisions in a vacuum. And I say that to say because I looked at your commentary from February 16th, Shades of 1979, and I want to talk about, as we close, I want to talk about that for a second, because that's, to me, I've heard, see, a lot of, a lot of times I'm one of those skeptical stock market people because I think that I know I'm not completely sure. I believe we have honest markets. I believe we have Fed induced asset bubbles, right? And so in your commentary, you talked about, gold has exploded, inflation is higher, and which is what the Fed wants, inflation, right? Um, and people equate higher dollar prices, stronger dollar, to lower gold prices, right? And so you said in the article, traders are perceiving that the Fed is in a box. And so talk about that with the, I think you're talking about with the tax cut, which will increase the deficit. The Fed really has been trying to raise rates, but they've also said they're not going to buy any more bonds. How does that? That's a lot going on there. That I think is really a lot of the what I call Main Street doesn't understand that and how that affects them. But I think it's really important. Can you speak to that for a second?
Well, yeah, I mean, gold is very sensitive to the value of the dollar. I mean, most commodities are. As the U.S. dollar weakens, commodities generally go up in price because commodities are again quoted against U.S. dollars. And when the dollar strengthens, then commodities tend to come lower. So what we've had since the bust in 2008 is we've had a Fed, not only the Fed, it's been every central bank in the world, Canada, Britain, the EU, Japan, that have been on an easing mode where interest rates have been pretty much at zero, and the central banks have created massive liquidity into the market by literally just printing dollars and issuing debt at zero. Now, what that has done is it's made the dollar less valuable because you're just printing more and more dollars, and that's why you had that run in gold from 2008 to 2011. In 2012, the Fed started to announce that they were going to start to ratchet back on their on the name of their programs were called QE, quantitative easing. They did two tranches of quantitative easing to get the U.S. economy restarted after the collapse in 2008. But they started to normalize interest rate policies in about 2012, where they stopped their spending programs, and they started to ratchet back on their interest rate liquidity programs. And over the past 2 years, they've now started to buy less bonds. They're trying to get that liquidity out of the market, and that's sort of tightening up the monetary supply, which is sort of increased interest rates. Now, the Fed's focus has been on two fronts. One is the employment front, and the other is inflation. Now, employment has come down to multi-year lows. But inflation has been stubbornly low. They were trying to get that inflation rate up to 2%. And it sort of comes down to be careful what you wish for, because now inflation is starting to pick up, but now the Fed's in a box because they want to raise interest rates. But at the same time, by raising interest rates, they've now got more of an accumulated debt load on their books. I mean, the Obama administration added $10 trillion to the debt Trump, just with his last two initiatives, the tax cuts and the proposed infrastructure plan, if that goes through, will add another $2.5 trillion to the budget deficit. And that's in the space of just over a year now. If Trump goes through with the infrastructure program. So now you've got the Fed raising rates, but they've got to finance that debt. But now they're financing the debt not at zero; they're financing the debt at 2.5%, where the 2 and the 5-year bonds are trading, and they're having difficulty raising money at that level because interest rates are rising because inflation is going up. So now you've got the Fed in a box. Now, if they want to really keep inflation down, they're going to have to raise interest rates more aggressively. But what does that then do to the housing market? And what does that do to the stock market when all of a sudden you get yields, especially on the 10-year approaching 3%? And we saw what happens to the stock market 2 weeks ago when that 10-year bond went over 2.9% for the first time in 4 years. The stock market got hammered. So the question now is, what does the Fed do? Maybe they let inflation run a little wilder before they get too aggressive with interest rates. But the problem with that is, if it's, we saw this happen in the late 70s, once inflation starts to take hold and starts to generate some momentum, it is very difficult to get ahead of that curve. So right now, the market is looking at that saying, boy, what's the Fed going to do? If they don't raise rates, inflation can take off, which would be very price positive for the metals. Also, believe it or not, price positive for equities. But if they stop that inflation surge, it's going to really impact the stock market, and it's going to really impact the housing market. So that also gives traders a reason, maybe I should hold some of my assets in gold because this could create another financial collapse. And a la 2008, although there were different circumstances then. So either way, this is sort of shaping up to something that could be very, very volatile, and certainly very volatile, but could also be very dramatic for both the housing and the equity markets if the Fed gets too aggressive. And I think that's why you're seeing gold hold up here.
Right. I mean, you have to see what's happening, because what happens is if they have to raise rate with all of the money they're borrowing, that means that, think about and I'm talking to the listeners here, if all of a sudden you've got adjustable rate mortgage and it goes up from 4% to 10, well, what goes up? That payment goes up. And so now you've got to take more of your income as a percentage to service the debt, right? And so that is what's happening. So now that debt has to be serviced. So all of a sudden, you're effectively cutting revenue, taxes, which I have no problem with, but you're not cutting spending, right? And so you're borrowing the difference, and you're in a situation where because the Fed wants to raise rates because they've had them at zero. I heard David Stockman say they want to have dry powder because we're in the longest bull market run. Is that in history? Did I hear that? And it just can't go up forever. And see, so they need to raise it, even though we don't want to, so that they can lower it again. So they have because the only thing they know how to do is inflate really. And I've heard not James Turk. What is my man? What is it? I forget his name right now. I'm picturing his face and I can't.
Peter Schiff?
With the boat. No, not Peter. Bow tie, older guys living in Asia.
Oh, yeah. Yeah, I see him as well. But it'll come to me.
Yeah. So anyway, he says, they have no, that's the only two things they know how to do. But so you've got to say, what I try to look at, all right, now, if that's happening, how do so there's two sides of that. So I don't really have the doom and gloom mentality. I say, all right, I need to have dry powder. I need to have cash. I need to have liquidity. So when things drop or businesses fail, that's a sale where I can pick up assets at pennies on the dollar. And so you need to position yourself to take advantage of that and not just, playing musical chairs, hoping markets go up, and you don't know what to do if they don't go down, because markets move up, down, and sideways. And, I've heard you need to be able to, if you're an investor, you need to learn how to make money in all three.
Well, yeah, I mean, Curtis, I totally agree with you. And again, you're a financial planner, so it really also depends on the risk tolerance and the age of the investor. Right now, and it's been a long time. It's been since 2008. It's been almost 10 years. I mean, right now, the older generation, the retirees, at least have the potential of putting some of their assets, where they're at least able to get 2 or 2.5% returns, uh, on their cash portfolios. Where in the past they were getting zero, and they were pretty much forced to get into the equity market to get any type of return. So this has helped somewhat. Uh, the older and the retirees, the older generation and the retirees, to be able to at least generate some income with interest rates moving higher. But there is a school of thought out there that the Fed might get into a position um, where they might need to just abandon the inflation argument, let inflation run a little bit, and continue to be less aggressive on interest rates for no other reason than to keep, for lack of a better way to say this, to keep the bubble going. Uh, because if the bubble collapses from these levels, the Fed doesn't have a lot of powder, even at the fact that they've raised rates 4 times since 2000 over the last 2 years. There's not a lot of powder to come back down, but there is a school of thought that if we get into that situation, the Fed might do another QE. It'd be QE 3 or 4, whatever the number is, to keep the game going.
Right, right. Yeah, I mean that's a lot of what's going on there. Yeah.
You need a balanced portfolio, and you need to be very nimble here. But yeah, you've really got to be diversified in this portfolio. And part of the diversification, whether it's, and we use the word gold, but gold really is sort of the inflation type of hedge, and the portfolio hedge relative to that. But you could hedge in other methods. You could hedge via oil. You could hedge via commodities. In the food sector, the soybean markets, the wheat markets. There's a number of markets that will react favorably if inflation does take off. But gold is the primary sort of catalyst that is the most sensitive to an inflation gauge.
Yeah. See, so glad you said that, because you have to say, okay, if you understand what's going on and you think there's going to be inflation, then what asset classes can you be in where inflation helps you, and helps drive your wealth forward. And you have to play offense and defense, right? And that's what you have to look at. And so I always tell people, look, diversification is not, 4 or 5 stocks or a bunch of mutual funds. You want to diversify among asset classes. So I break them down into 4: business, real estate, paper, and commodities. And commodities would be gold, silver, oil, gas, agriculture, or paper. Paper is equities, but it's I deal in alternative investments. So it's bridge loans and merchant cash advances. There's life settlements. There's what else things called tax lien certificates if you're in the U.S. And so there you just have to which so what's your first best investment, guys? Don't take anything on this call as investment advice, because you need to speak with your professional that can help you do that. Maybe and but you want to learn. So your best investment is in between your two ears. Stop taking advice from other people. You need to have opinion to build your team, but you need to educate yourself. So your best investments in a book, in a course, in something where you can learn a little bit about something, right? And read, and listen, and podcasts, and all that kind of stuff. So Peter, as we close, I want to thank you again for coming on. Tell them a little bit about Kitco, and how they can follow you, and what if they want more information. What's the best way to get in touch with you?
Yeah. Well, you can reach me at phug, H-U-G, at kitco.com. That's my email. So feel free to send me emails if you have any questions. Can't promise you I'll get back to you the same day. It really depends on what I'm doing in the markets, but I will get back to you and answer your questions. But I wanted to, on this, I don't want to make this sound like a promotion of Kitco, but I wanted to make this following point. Again, having been in the market since 1974, I've seen a lot of dealers in my time. And I have to tell you, other than the fact that, Kitco offers physical precious metals, we can deliver them, we can store for you, we have trading accounts. We offer a full range of precious metals investments for the physical buyer. Where I am very sort of impressed, let me put it that way, and it takes a lot to impress me, with Kitco, is the actual website, kitco.com. That's not run by the precious metals division. That's run by our media division. And it really does give a very, very balanced view, not only of the precious metals, but also of currencies and just general investments, be they equities or bonds. And, there are a multitude of analysts that provide their input or their views on various markets. And, they're not all bullish. I mean, believe it or not, I get a lot of complaints from investors saying, you've got a guy on there saying gold's going to go down. Why would you do that? You're a precious metals dealer. Why would you have somebody say that the market's in a bear market? But that's where I find Kitco extremely unique. On kitco.com, you will get an assessment that is based on what an analyst believes the market is going to do. And sometimes they'll be bullish and sometimes they'll be bearish. But it does provide a good overall picture of what a variety of people are thinking on the market, so that investors can go and read these commentaries and then make their own decision. So I find that very valuable. Now, what I do for Kitco is I put a blog on usually every day, but at least 3 times a week, where I give my opinion on the markets, but I do it from a trader's perspective. I believe clients should hold a position in gold, but I don't address those clients. I address traders, and there I get a bit more technical. I talk about support and resistance lines, where I see the market trading on a daily basis. If I believe the trend is up or down on the short-term basis. And again, my opinion, and there are times I'm wrong, but I'm not giving it from the perspective that you should buy or sell. I'm just giving a trader's opinion of where I see the market's trading in the short term. Again, something people can read and make their own decision from. So that is something from a perspective of a metals dealer. If you go to any other site, you very rarely will find the kind of quality commentary that Kitco.com provides on its site. And it really is a good educational tool for investors that are trying to get into the market and trying to understand better what's making the market move up or down.
Okay, that's great. What's this? So tell them the site.
Kitco.com.
Kitco.com. So we'll put that in the show notes. And any final thoughts for our listeners?
I can tell you one thing that's going to happen. This is not going to be a dull year. It's going to be extremely volatile. And I think the volatility is going to continue, and it's really going to create some anxiety for investors, no matter what asset class you're invested in. So you need to make a plan. You need to stay balanced. You need to stay diversified. And sometimes you just don't listen to the noise, and just stick with your plan. And every 3 months or 6 months, take a look at your portfolio. And if you've got to rebalance it, that's when you do it. And it's best to do that with a financial planner that understands the markets, that can help you to rebalance your portfolios. But it is important to have diversification in this market.
All right. Sounds good. Well, so we're going to close with that. And so I want to thank our special guest, Peter Hudd from Kitco Metals. And this is Curtis May from the Practical Wealth Show. And we are out, and I hope you enjoyed this episode. Please leave us a comment on iTunes or Stitcher, and share the show. And we will see you guys next week. Thanks again, Peter.
Thank you, Curtis.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be granted before syndication or rebroadcasting.